Hey, this is Chris from StockSpot. Now, something you can be absolutely certain of every time there's a market sell-off, like there is at the moment, is that active fund managers will come out having a go at ETFs and indexing and say that they're distorting markets and causing markets to be more volatile. Here are 4 things you can say back to them to help them understand why that makes no sense whatsoever and is just a furphy that likes to get perpetuated by active fund managers. The first one is that although ETFs own a big part of the overall market, and that's growing, in Australia it's something like 15 or 20% now, and it's a bit more in the US, they own a lot of the market, but they don't do a lot of the trading. And the reason for this is that ETFs are buy and hold investors. They're not buying and selling every day, although there's inflows coming into these ETFs that add money into them. And occasionally there's index rebalancing that happens once a quarter. Generally, they're not participating in the buying and selling that happen every day. That's active fund managers. 95% of trading happens between active fund managers betting between each other. And that's what's leading to price discovery. And that's what's actually causing markets to go up and down, not indexing. The next thing you can say is that ETFs are still getting inflows even when markets are falling. For them to be distorting markets, you'd need to see a whole bunch of money getting yanked from them when markets are volatile, but that's not what we're seeing in Australia. ETFs are still seeing money coming into them when markets are falling, and so they're actually having the opposite effect. They're actually helping to support markets. They're not causing more market volatility. Sorry for interrupting, but I'd like to take a moment to talk about my channel. Now, most people who watch my videos don't subscribe to my channel, which means that they don't find out about other videos I'm making, and it doesn't share the love with others who are interested in investing. So if you are interested in videos like this, I would encourage you to please subscribe to my channel so you find out more about the videos we're making here. The third thing you can say is if ETFs were causing markets to be distorted and moving together, what you would expect is companies within the ASX 200, which is the big index in Australia, to all move together, but they don't. Over the last couple of months, shares in some of the big banks, for instance, have fallen, but shares in the big miners that are mining gold, like Evolution Mining, have risen. They've moved in opposite directions. And again, this is because active fund managers are actually the driving force between price discovery and driving prices higher and lower. It's not index investors at all. That's active investors actually leading to prices moving. So to summarize all of this, what I would be saying to this person that's trying to convince you that markets are more volatile because of indexing is that if this were indeed true, what you would expect is to see active managers taking advantage of that and beating the market, because there's obviously so many opportunities for them to jump onto. But that's the opposite of what we're seeing. In fact, during the COVID market volatility or previous market falls like the financial crisis or the dot-com bust, we actually saw the average active fund manager underperforming the index. And so it's not at all that these are causing more opportunities. In fact, markets just structurally are getting more and more hard to beat. And this is what ETFs are helping to do. So in summary, when someone tells you in markets are volatile that ETFs are causing this market volatility, you can blow that away, because markets have been volatile for many, many centuries, well before ETFs or indexing came into popularity. Market volatility is caused largely by greed and fear and the psychology of market players driving prices up too much or down too much. But that doesn't mean that markets are easy to beat, and it also doesn't mean that ETFs are causing this distortion. It just is the nature of markets and the psychology of participants in those markets.